Good morning, everyone, and welcome to today's webinar, the Top 10 Tax Planning Tips for 2021. We thank you all for your attendance and appreciate your time. We know that everyone's in lockdown at the moment, so it's been a good opportunity to run this webinar and get in touch with you all around year end. As you know, for us accountants and for a lot of you who are in business, of course, as well, year end is fast approaching, so this is the time to think about tax planning. There's an old saying that goes, there's only two certainties in life, death and taxes. And so as accountants, we're very well aware of that. But I think if you live in Victoria, there's now three certainties. There's a new one, and that's called lockdowns in Victorian winter. So we hope that this lockdown will be over soon. And we look forward to all getting out there again. So for today's presentation, we have Mark Forte and Leanne Trask. So many of you have met Mark before. Mark's our resident tax expert at Wilson Pateras. So Mark will be covering a number of the tips today. And Leanne, we welcome Leanne from Les Taylor and Associates, which is a business which recently joined with Wilson Pateras. And we're very excited to have Leanne today presenting. So without further delay, we've got our little chat and Q&A box there. So if anyone would like to put forward your questions for today, please feel free to do so. We'll do our best to answer those questions as we go along. Yeah, we'll have a good session. We'll go for hopefully only the half an hour just to let you get on with your day. So yeah, without further delay, it's over to Mark to kick off.
Okay, thank you, Nick. There's our normal disclaimer. So we'll kick right into it. It's going to be a very fast-paced session. We'll go through not too much technical detail, but just the top 10 tips that we see going at the moment. So to hit it straight off, what is tax planning and what do we do? So what I'll do, I might sort of start things off by quoting a very famous Australian, which is Kerry Packer. And what Kerry Packer said in some type of Royal Commission that he was building, he said, of course I am minimising my tax. And if anybody in this country doesn't minimise their tax, they want their heads read. Because as a government, I can tell you that you're not spending it that well, that we should be donating extra. So basically, to paraphrase that, it is un-Australian not to try and minimise your tax. So as accountants, what we do is we look at the different tax rates that are available within the Australian tax system, and you can see those on your screen. Our top tax rate of 45%. It is high, but to sort of compare it to other countries around the world, just quickly as some fun facts, Austria's top tax rate is 55%. The Scandinavian countries are around about 57%, and China's at 45%. So it's sort of similar to the developed world. It's high, but within the ballpark. Other tax rates there, you'll see at a company being 26 or 30%, and I'll get into more detail a bit later on while there's a difference. And superannuation, which is, I suppose, the golden child of tax structures, can either be 0% or 15%, and we'll go through an example of that a little bit later on as well. So what we do at Wilson Pateras, we have a tax planning season, which runs between April and June. So that's when traditionally it happens. And during tax planning season, what we do for clients that want their service, we estimate what the tax is. We sort of try and forward plan cash flow for tax payments. That's very critical given today's, I suppose, environment that we're living in. We try to determine strategies to reduce the tax to get into the bands that you see on the screen, particularly the lower type of bands. We create trust resolutions, which we'll discuss a bit later, and also dividend resolutions. So moving right along to the first tip that we have, which is one which has got a lot of press, is relation to home office claims. So this is tip number one. And most of you may be familiar with, there's an 80% rule, 80% per hour. We can claim that based on hours that we work from home. But what is little known is that there's three methods to claim home office claims. So the first one that I just mentioned is a shortcut method. It covers those expenses that you can see, being phone, internet, depreciation of furniture and equipment. And equipment's very important, as I'll explain in a sec. Electricity and gas. There's nothing else you can claim. It's a straight 80% per hour. In order how you determine that is that you must keep a record, and this is where record keeping is very important. If you're ever in an ATO audit or review, keep a diary, keep a timesheet, keep an Excel spreadsheet, but just record the hours that you're working from home. If it's between 8 and 5 o'clock, you take an hour for lunch, record all that. Because if ever asked by the ATO, you'll be required to submit those documents, otherwise your claim will be rejected. So that's the easy way to claim home office. The second way is a fixed rate method, which was pre-COVID and is still applicable today. So you can claim 52 cents per hour. But what you'll notice in the second bullet point, it does cover the cost of depreciation on furniture, but not equipment. So as we go down a bit further into the third bullet point, what you can do, if you have bought a laptop, like for myself, I've bought a shredder, I've bought an overhead lamp, and I've bought a printer and scanner. So I wouldn't use a shortcut method because that may not give me the best result. I use a fixed rate method, claim my 52 cents per hour, and then I can claim depreciation on those items that I've just mentioned. If those items cost less than $300, then you get the full write-off. So that's another method of doing it. In terms of record keeping, then just make sure that you keep like a logbook for a representative 4-week period, which sort of represents, I suppose, a normal type of working week for you. For any small expenses that are less than $10, but no more than $200 in total for the whole year, keep a logbook of that. Keep a record of your work-related internet use. So if you're working in the office for 8 hours for the whole day and using, and obviously then a 24-hour period, but you're using the internet, then obviously that's just 1/3. And just keep a percentage of business use of any type of assets that you use exclusively for work. Moving on to the next slide. Other things that you need, obviously, to justify your claim is receipts. It's just, I suppose, a record keeping 101. And if you do have a phone call, like a mobile phone, for example, and you can identify your total calls and your work-related calls as a percentage, keep that for a representative 4-week period. There's your business percent. Then we claim your mobile phone bills accordingly. The third and final way, but as the actual cost method, Nick sort of gave me the hurry up there, but nobody uses the actual cost method because it's just too difficult. So tip number 2, in relation to superannuation, is something that came through which you can use this year. It's called catch-up contributions. To be eligible, your superannuation balance as of 30 June 2020 must be less than $500,000. And it's applicable for those people that haven't used their maximum concessional contribution cap of $25,000. So to run a very quick example, we have John and Susie. They've got a self-managed fund. During 2020, due to tight business conditions, they did not make any super contributions at all. So for the year ended 30 June 21, business conditions have improved. They can not only make the contribution they could have made in 2020 of $25,000 each, but also pay this year's contributions of $25,000 each, and there's $50,000 per person to claim as a tax deduction. The second one in relation to super is a double dip of contributions. So what this means that you can actually prepay your 2022 contributions before 30 June, but that contribution must be paid during the month of June. So therefore, as an example, we've got Oscar, who's self-employed. He's made his total concessional contributions before the 1st of June of 2021. So that satisfies his 2021 deduction. On the 8th of June, he decides, well, I've got a bit of extra cash. Let's make a further concessional contribution of $27,500, which is next year's contribution limit for next year.
So Mark, that means then that people could put in $77,500 in theory before 30 June.
Correct, you can, because you're using the catch-up contributions, the 25 for this year, and also the $27,500 for next year. Yep. So in total, as Nick said, yeah, $77,500 maximum. And this will be a very good type of strategy if you have made a very large capital gain, say you sold Afterpay shares, that was a golden child of the stock market. And here's a good way to bring down that tax to get into that lower tax band that we use.
Yeah, so you might have made a large capital gain this year, your income goes to a high tax rate, but make a very large super contribution and get that tax rate right down.
That's correct. I'll move on to the next slide, which is over to Leanne.
Welcome, Leanne.
Hi, thank you. Okay, so we're looking at motor vehicle expenses. There are a couple of methods that the ATO allow. Let's look at the first method, which is the logbook method, and why you should maintain one. There are a couple of reasons why. One is that you use your car for work-related travel. Work-related travel can include things like travelling between campuses or sites, travelling to attend meetings, conferences, or work training or courses, travelling to pick up goods, supplies, or equipment for work. If you travel more than 5,000 kilometres, this is a good reason to maintain this format in a logbook. You must be the owner of the car, so that's important to note as well. So you only need to keep a logbook for once every 5 years. Even if you change cars, that's okay. You just have to nominate the new car in writing. The percentage of work-related travel is then calculated. So you need to keep personal versus private usage. And once you have worked out that percentage, you can allocate all of your expenses to do with the car. And that may include things like registration, insurance, and all other receipts to do with expenses to do with cars. So how to keep cents per kilometre. Let's move to the next one. This is important to keep a diary note that the ATO might require. Generally, you will travel up to 5,000 kilometres. And it's really important to note that the ATO do not hold a copy of your logbook or your diary notes. So that is up to you to keep this record. Of course, your accountant can also keep this for you as well.
Yeah, thanks, Leanne. It's really interesting when we're talking about both home office and motor vehicle expenses, in that these are things that typically salaried employees would often claim. And it's probably the two areas that there's not a lot left that people can do with a salaried employee to claim, and they're two very important areas. So I think I agree it's really important for people to maximise those claims in those areas. Otherwise, there's not a lot left to be able to reduce tax.
They could be quite big deductions if you are using your car a lot for those reasons mentioned. So
yeah.
it
and the ATO
definitely
recognises
worth
these
looking
deductions,
at
don't they? Yeah.
applying the logbook method if you feel you're travelling a lot for work, for sure. And you're not reimbursed, obviously, by your employer, I should say. Yeah.
And the devil's in the detail, I think. Yeah, making sure that you are recording that 12 weeks correctly. If you get that right, then you don't have an issue. Yeah,
for sure. Okay, we're moving on to prepaid expenses. So, a prepaid expenses may be immediately deductible if it is classified as excluded expenditure. And what we mean by excluded expenditure is expenses less than $1,000. It could be wages or salaries. So, or prepaid expenditure may be deductible if you follow the 12-month rule. What do we mean by the 12-month rule? 12-month rule is if you are a small business entity or an individual incurring deductible non-business expenditure, you can claim an immediate deduction for it. You can claim this expenditure if the payment is incurred for an eligible service period not exceeding 12 months and the eligible service period ends in the next income year. So it's not for expenses for 5 years in advance, but if it is within the next 12 months, but overlapping in the tax year.
So Leanne, I seem to recall many years ago, it was probably more common for things like interest, for instance. You know, you'd have clients who would get to this time of year, they'd go speak to their bank and they'd say, bank, I want to prepay the next 12 months of interest and get a very large tax deduction. It seems to be less common now though. I'm not sure why, but there's certainly a very large benefit there if you can prepay that 12 months in advance and you have the cash flow, of course, to be able to do that.
That's correct. You must have the cash flow. I think that's important to note, but it's certainly, if you can allocate it to an expense item and reduce your taxable income, ultimately you're paying less tax. And I think that's the aim for a lot of people. Yeah. And the tax law does allow you to prepay certain costs, as mentioned, interest and rent. So it's definitely worthwhile if you have the cash flow. Also mentioned on the slide is the small business entities. So the benefit, obviously, of an immediate tax deduction may be greater where assessable income is currently higher than expected in that current year. For example, you know that you're not going to be earning so much in the years to come. So it can be lucrative, or it can be to your benefit to prepay that expense, reduce your taxable income, and then ultimately pay less tax.
Yeah, excellent. And tip number 5.
Okay, negative gearing. This is always an interesting one. So when you purchase a growth asset, and when we say growth asset, we're generally referring to something like shares or property. You can, the interest cost on the debt is tax deductible, and effectively you can have a tax loss. So what we mean by that is, here we go. The key benefit is that any net loss you incur can be put against your income you earn from your employer, such as your salary. So ultimately, you're reducing your taxable income again, and then you're reducing the tax you have to pay. So borrowing to buy shares is an excellent form of negative gear and a tax-effective way of building wealth. So the shares might go up in value, but at the point in time that you're borrowing, all you're getting from those shares is, it could be some franking dividends or some franking credits. And so that interest expense may even be higher than those franking credits, and that can go against your taxable income. So it thereby reducing it and reducing the tax you have to pay. So we've got a great example here on the benefit of negative gearing for new property, which has tax deductible depreciation. So if we go through that, if you're on the top marginal rate, being 47%, you can lower your tax bill by. So rent being the rental income that you're receiving on the new property that you've purchased. Interest as an expense of the $12,000, less all your capital expenditure that you may have incurred in buying that property of $15,000, and other, let's make it simple, call it $3,000, which can include things like council rates and repairs to any assets you may have, and ultimately you have a tax loss. So the benefit of that tax loss of $20,000 at 47% is that you are now not paying $12,690 that the ATO is not getting, because you have negatively geared that property.
I find the negative gearing one a really fascinating one, because it's one of the last policies that the government has, which I believe is a real genuine incentive. So the theory behind negative gearing is that the government's paying you a sum of money to essentially lose a level of ongoing profitability from an asset. So with this case of this property, the loss includes the depreciation, the loss of the value of the building, which is not a real cash outlay. So you end up finding a lot with, and we see this anecdotally through our clients, is that the government's encouraging people to buy an asset, which at the moment, for instance, with property, is going up at an incredibly fast rate, and they're paying you money back in cash flow to do it. And it seems to me like a really, it's not just a tax benefit, it's actually a wealth creation method as well. And a lot of businesses over time have been built off the back, a lot of consultancy businesses built off the back of acquiring property and so forth. And you can see why, because the benefits still remain to be quite relevant. And we think about this in the context of using multiple tax tips. So we've got an interest cost here of $12,000, but imagine you prepaid next year's interest and you had another $12,000 on top. So this particular example would be a $32,000 tax loss if you also did the previous tax tip of prepaying interest.
Have the cash flow, it's certainly worth doing it in this way.
Yeah. Over to Mark. Thanks, Leanne.
Okay, so now we get to the stage of the presentation, we talk about structures. So those with trust would know at the moment we're sort of busy preparing trust resolutions for 30 June. So what happens with trust, if we do not prepare those resolutions and the trusts are not able to distribute income to beneficiaries, the trustee will pay tax at a flat rate of 47% from $1. And that's something that is, it's very, very poor tax planning. So these resolutions, as guided by the ATO, they must be in place by 30 June each year. So what it does prior to 30 June, it gives us the ability to review the actual tax profile of the trust, see what the taxable income may be. Then we can hopefully, I suppose the trust resolution will say, we will distribute this amount of money to, or this amount of cash to the beneficiaries. Hopefully they're low tax rate beneficiaries. So in terms of different strategies that we look at prior to 30 June, obviously the most important one there is to try and stream as much income to the lowest marginal rate taxpayer. So you might have an adult child who's going to university, doesn't have any type of employment income or no other income at all. The first $18,200 that you distribute to that to that person at uni will pay no tax on. So that's a very, very good incentive to do that. other strategies is that we can stream different classes of income, whether it's a capital gain or a franked dividend or any type of other income. And where this becomes important is where if there's a beneficiary who has an existing capital loss in his or her own name, the trust has made a capital gain on the sale of the property, then we can authorise through the trust resolution to distribute that capital gain to that particular beneficiary and pay no tax or reduce tax. In relation to franked dividends, maybe a bit of an outlier type of strategy. If you do have non-residents overseas and you are going to distribute cash to these people anyway, any franked dividends will not be taxed. There's just no tax rate for franked dividends distributed to non-residents. So that's an example of streaming different classes of income, but that must be allowed for in the trust deed, which is the governing document. You can also, another strategy, distribute fixed percentages. So it might be a third to three different beneficiaries. Use of children under 18, whether there's much use of doing that, considering the most that you can distribute tax-free is $416. I don't recommend it, particularly if there's an adjustment. The HA comes in, reviews your taxable income of the trust and says, well, you shouldn't be claiming this expense. All of a sudden that child will pay tax at a very high rate on the adjusted income in his or her own name. You can distribute to other licensed entities within your tax structure. So another trust might have a loss in it. So you distribute from a trust that has a profit to a trust that has a loss, and that taxable income is all absorbed. And one thing that we do not do, we do not distribute to a self-managed super fund, even if it's in pension phase. Reason being is that it's deemed to be what they call special income, and the tax rate is at 47% on that distribution.
So Mark, I think it's very common that we have clients with their children, for instance, they might have adult children, so children over the age of 18, who may not be working full time, and that is often a common beneficiary in a family trust. Some of the traps we see in that is potentially the repayment of student loans that can also need to be factored in and can often be forgotten when we're doing those kind of things. Yeah, it is.
And just one important point in distributing to, I suppose, adult children is that if the distribution remains unpaid, it builds up as a liability owing to that adult child in the accounts of the trust, and they have every right to call upon that money. So what a common strategy is to circumvent that, there's a couple of strategies. One is that you may pay for their expenses out of the trust, so that is deemed to be a payment to reduce their liability, or they can assign that particular, what they call unpaid entitlement, to the mum and or dad. So that's basically one of the strategies we can do. So flowing from that, in terms of beneficiaries, you could set up what you call a bucket company. If I was to align this to a golf course, and I'll call this is a signature hole, this is a signature tip. That's what I would say. So what is a bucket company? A bucket company is just a normal company. The tax rate can either be at 30% or 26%. Now, the 26% tax rate applies where at least 20% of the company's gross income is business income or trading income. If it's less than that, then the tax rate will be at 30%. So the benefit of a bucket company is that it will defer tax to later years. Because you have to remember that a company, if you distribute to a company, it has income already. It will build up its retained profits over many, many years. But that retained profits at some point should be paid or must be paid to the shareholders. And then when it's paid to the shareholders, it comes out as a dividend. That dividend will then be taxed in the name of that particular shareholder. And depending on that shareholder's tax rate at the time, either there's additional tax to pay or you may get a refund of franking credits. And I've seen it go both ways. So as a very basic example, a trust has income of $500,000. We need to distribute. We don't want to keep it in there, otherwise we pay tax of 47%. So say we distribute that $400,000 of it to a bucket company, assuming the bucket company is a non-trading company. Tax at 30% is 120 grand. If we were to distribute that same $400,000 to an individual on the top marginal tax rate, their tax would be $188,000. So in this case here, we've got a tax saving or deferral of $68,000, which can be used in the trust for either investment purposes or business purposes.
Yeah. So I guess the benefits of a bucket company, Mark, are that you get either a tax deferral for most people, semi-permanent tax saving for some, depending on their structure. The downside is it gets a bit more complicated. There's some documentation, there's some more complicated tax rules that we as accountants need to follow, which may increase the cost a little bit, but it's a cost benefit. You know, you say to often a person, you can get a $68,000 benefit, but you're going to have to put some documentation in place. They're probably going to more likely want to be doing it.
No, exactly true. And you can manage the use of a bucket company quite easily. It does take a little bit of work, and like you say, it is an increase in cost, but the cost generally, actually the benefit actually outweighs the cost to a large extent because of the tax deferral that you have, which that tax will be deferred to many years. And what I do with bucket companies, I generally set up another family trust or discretionary trust to be a shareholder. So that way, any dividend paid from a company to that trust can then be distributed to low tax rate beneficiaries. So that way, you really reduce the top-up tax that ordinarily is associated with bucket companies.
Yep.
Okay. So tip number 8, buying an asset, instant asset write-off. Again, this has received a lot of press. So there's 2 different ways to claim. One is the instant asset write-off, as we're fully aware. We can claim up to $250,000 in full. The criteria is that the asset must be purchased by the 31st of December 2020, which is obviously gone, but installed and ready for use by 30 June 2021. But what has, in effect, overridden that particular, I suppose, tax concession is something called the full expensing of depreciable assets. With that is that it applies to any asset that was bought on budget night, which was 7:30 on the 6th of October, and any asset bought and installed ready for use by the 30th of June 2022. There is absolutely no threshold in that. So you could buy an asset for $1 million and claim a full deduction for it. So that's how powerful this particular, I suppose, tax benefit is. But a very basic example down below, we have Simone, who runs a food manufacturing business via a company. She decides it's time to upgrade a machine that mixes her food ingredients. The machine costs $250,000, excluding GST, and she is financing that with a bank loan or a chattel mortgage. So tax benefit in year 1, you get the GST credit back of $25,000. The tax benefit of the new machine is $250,000 multiplied by the company tax rate, which is 26%. So there's a $65,000 cash flow benefit. You're not paying that in tax. But the total cash benefit for the company in this one example is $90,000. So if you think about it, if you go and borrow $250,000, interest are at all-time lows. So you're then repaying back that loan maybe over a 10 or 15-year time frame, but you're claiming up the deduction up in the very, very first year. So it is a very, very powerful incentive to actually go out and buy the equipment or machinery that you do need. I wouldn't do it for the sake of getting a tax deduction. I'll do it because of the need to actually buy the equipment. Given that we've got till 30 June 2022, it's not only a tax planning mechanism for 2021, but it's also for the following 12 months as well.
Mark, someone would need to be running a business in order to make this.
Need to be running a business, so it's not valuable for salary and wage employees. It's not eligible for a contractor. He's only got the one contract with one particular company. It's one that you have to qualify as a business. Not a small business, because it can be up to a turnover of $5 billion to qualify for it, but it's one that you have to be running a business. Okay, one delving into the pension side, and I must qualify this before anything, is that if you're ever considering starting a pension and you are seeking advice, that advice must be given by a fully qualified financial advisor under the Corporations Act. Maybe familiar with the Royal Commission a couple of years ago. We see people carrying out on stretchers and everything else for giving wrong advice or bad advice. So that's the reason why we do need to get that signed off by a financial advisor. So in terms of just generally speaking, when you're considering starting a pension, one, looking at tax rates, as I mentioned in the very first slide, the tax rate is 0%. It is the most tax-friendly environment that you're ever going to come across. You can actually increase the investment return, because what happens there, if you are invested in ASX shares that you do receive franking credits, those franking credits will become refundable. So 10% return with franking credits, it might be an 8% return. The downside, if there is a downside, is that a minimum pension payment must be made each year. Currently, between the ages of 65 and 74, in that age bracket, it's 2.5%. That's because there's a COVID in session 4, normally it would be 5%, and the older that you get, the percentages do go up. But you could only start a pension if you met a condition of release. So that's all based on what they call preservation age. If you're born after 1 July 64, the age is 60. Before that, it's sort of transition between different types of ages from 55 to 60. A condition might be that at the age of 60, you have 2 jobs, you leave 1 job. You've met a condition of release because you're deemed to be retired, even though you still got that 2nd job. You compare that to not starting a pension. That means you're in what they call accumulation phase. The tax rate for that is 15% and 10% for capital gains, provided you own the asset for more than 12 months. There is no requirement to take out money out of superannuation. And it may suit those people that are still working or have an income stream outside of super, such as rental properties or commercial rental properties, and they use that to fund their lifestyle. So instead of drawing money out and reducing a super balance, they might want to leave it in to grow it, just through a compounding type of effect. Next slide, Dick. Yeah, so I just got a basic example. We've got Sam, who's 67 years old, have a self-managed super fund with a balance of $1 million at 30 June 2020. He has no other source of income besides his earnings from his self-managed super fund. The fund invests in ASX shares, and for the year ended 30 June 21, has received $70,000 of dividend income. So for tax purposes, the income is $100,000, and there's a comparison in that table below. So as you can see under the tax refund line, is that in pension, you get full use of those franking credits. It comes to you as a refund, which you can take out to fund your pension payments. As in accumulation phase, the refund is reduced because there's tax to pay of 15%. And even though the minimum pension at 2.5% for Sam for 2021 is 25 grand, if this is his only source of wealth that he does have, in accumulation phase, he still can take money out, but it's just going to reduce his super balance. So this is sort of one very basic example where Sam may be better off commencing a pension than staying in accumulation. Excellent. And tip number 10, trust versus company. We get this question asked all the time. What is the best structure to buy property? And I've got to say at the outset, when you're talking about structures, there is no right or wrong answer. There's no black and white answer. It's what suits the client's or what the person's circumstances at the time. So in this case here, we have Jackie, and she wants to buy a property, and she wants advice in relation to buy a property in a company or trust, and she's doing it for asset protection purposes. That's why she's not buying in her own name. Considerations that we look at. So from a trust point of view, if the asset is owned for more than 12 months and you were to sell a capital gain, and then that capital gain will be tax-free, and you can distribute that from the trust, and there's no further tax implications. If that's the only asset of the trust and it is negative yield, then the losses are trapped in that trust. You cannot distribute losses to beneficiaries. The only time that you can use those losses is when the trust has profits, whether you distribute from another trust or the trust has different source of income coming through. That's when you can use those losses. If it's positively geared, however, that is, there's a net income to distribute to beneficiaries. You can distribute to hopefully low tax rate beneficiaries and cap the tax to a very, very low amount. Something that people tend to forget about is that land tax is higher because it's what they call the land tax surcharge rate. So up to land values, not property values, but land values up to $3 million. The land tax in a trust is generally 3 times as high as if you bought the property in your own personal name. So just something to be aware of. And the other thing, which again was a change in the law from the 1st of March last year, is that if your trust deed has the ability to distribute to residents overseas or to non-residents, and there's an extra 8% stamp duty on the purchase of the property, and also land tax is significantly higher as well. So in that case there, with clients with existing trust deeds, we would amend the trust deed just to exclude foreign beneficiaries, or we'll set up a brand new trust excluding foreign beneficiaries. So you compare that to a company scenario, the tax rate is a flat 30% or 26% as the case may be. Losses are also trapped, so you cannot distribute negative admin losses to a shareholder. To access any type of rental profits or capital gain on the sale of a property, the rental tax rate could be as high as 47%, because remember that the company will pay tax, say, at 30% on the profits, but those profits, if the shareholder wants it, must be distributed to that shareholder, and it all depends on his or her tax rate at that point in time when they receive the dividend. But where it's beneficial using a company is where, say, we have to use it as a bucket company and there's a lot of cash in that bucket company. Instead of taking the money out as a dividend and paying that extra tax, you may say, well, I think I'll defer the tax for another 30 years. And there's this really good commercial property which I want to leave as a legacy to future generations. Let's just buy that property there in the company, so that way we can defer the tax for a long, long time. So that's probably an example which is becoming more and more common that I see, is that what clients are doing.
Yeah,
so
I think it's one, the trust versus company scenario, Mark, where sometimes clients will, where we're preconditioned, interestingly, I think, as a society now, when it comes to making investment decisions, that you default to a trust. But you made the point there that I think more recently, companies are becoming more relevant as an investment vehicle, because the way the tax system's design is that the corporate rate is much lower than, significantly lower now than the individual rate. So there's an encouragement to keep money and equity and value within corporate structures versus withdrawing that money out.
That's right. And when you consider the company tax rate will reduce to 25% as of 1 July 2021, if you were to sell an asset that you've held for more than 12 months, you'll pay a tax of 25%. You can use the company to reinvest that. If you were to sell that same asset in a trust, the top tax rate that you'll pay is 23.5%.
Yeah.
So there's not really a large gap in terms of tax saving between a trust and company when you look at it from that point of view.
Yeah. So it's one now where I recommend, I think probably 4 or 5 years ago, it was almost like an assumption you'd have a trust. I'd recommend anyone who's on this webinar that if you are considering making a significant buying decision with an asset, that you ask us to conduct a more comprehensive review of what you're going to be doing. And Mark's just outlined there, I think, 10 different issues that we need to contemplate. The best thing you can do is make your decision contemplating what you think might happen in the future. And I think those things are best determined when you have a conversation with us as accountants. You say, okay, I'm thinking of buying this asset. I'm thinking it's going to be dealt with in this particular way. It's going to earn this sort of income. It's going to have this kind of growth. That helps us to formulate the right decision with you, versus maybe we often get clients who will just quickly call up and say, I need a trust set up. I'm buying this asset. So I certainly encourage you to be more collaborative when it comes to those kind of issues. We are slightly over time, but we have our 3 key takeaways. So I think to that end, one thing I'd encourage everyone on this webinar to do is to plan early and talk to your accountant. So we're in the month of June now. This is tax planning time for the accounting industry. So please get on the front foot and contact us if we haven't contacted you already to arrange a tax planning consultation. So what we do at Wilson Pateras is we will take your data and information. We'll understand where we believe you're at for the 2021 year, come up with a tax plan, and then work with you on some of those proposals and tips that we've mentioned today. So please act early, come and talk to us well before 30 June, because as you can see, some of the things there will require you to act in the next couple of weeks. Secondly, I think the takeaway is to manage a tax rate. So I'd encourage you to not just look at the amount of tax you're paying, but work with us to understand better what is your average tax rate. Mark's outlining there some interesting information around 25% tax rates in companies versus the 47% for individuals. So we want to work with you to manage that tax rate and minimize it within what's reasonable. And the final thing, particularly for individuals, this is really important, is to maintain all the records of your costs. The ATO has been very vigilant over the past number of years in reviewing what we call the D items in the tax returns. These are the items that individuals typically will claim for things like home office and motor vehicles and other expenses. So maintaining a record of all your costs is critically important if you ever ask questions about it in the future. So we do have a couple of questions. I've endeavored to answer each person back individually on those questions, but if I haven't got back to you, we'll be sure to come back to you after this session's ended. So that's all for today, guys. Thank you very much, Mark. I've appreciated your time. And thank you, Leanne, for your first presentation. Leanne, you've done so well. We might ask you to come back again. So no, thank you, guys. Really appreciate it. And thank you to all the participants. Really thank you for coming along to today's presentation. Look forward to seeing you again very soon.